What's up everyone, and welcome back to Explain the Charts. Today is October 7th, 2025, and we are looking at some explosive action in the Nasdaq, which just notched another record closing high yesterday. The big headline driving this momentum is the mega deal announced between chip maker AMD and AI giant OpenAI. According to reports, AMD will be supplying OpenAI with billions of dollars worth of chips over several years, setting them up as a serious competitor to NVIDIA in the AI space. This news sent AMD shares soaring over 20% and ignited a rally across the entire tech sector, pushing the QQQ to new heights. Interestingly, this rally is happening despite the ongoing government shutdown, which is delaying the release of key economic data the Fed uses for its policy decisions. This creates a fascinating dynamic where market sentiment is being driven almost purely by a powerful tech narrative rather than traditional economic indicators. Now, let's see how this powerful news is reflected here on the QQQ daily chart. As you can see, we have been in a strong, clear uptrend for the better part of 2 years, with pullbacks being aggressively bought. Yesterday's candle represents that big breakout to a new all-time high, closing strong at 607.71. This move decisively broke through the previous resistance level established in mid-September around the $600 mark. Whenever a long-term resistance is broken, it often becomes a new floor of support for the price. Before we look at the recent action, it's important to remember how volatile this market can be. If we look back to the spring of this year, we can see a major test of this bull market's conviction. Let's zoom in on that period from March to April 2025, which was a critical stress test. We saw a very sharp, high-volume correction that took the QQQ from around $540 all the way down to a low of nearly $400 in early April. That was a gut-wrenching drop of over 25% in just a few weeks. But look at the recovery, it was just as fierce. Notice the massive green candle on April 9th, where the market exploded higher by over 12% in a single day on immense volume. This V-shaped recovery demonstrated that there is a huge amount of capital on the sidelines waiting to buy any significant dip, reinforcing the underlying bullish trend. Now, let's switch to the 1-hour chart to analyze the structure of this most recent breakout. Leading up to the beginning of October, you can see the QQQ was consolidating in a tight range, mostly between $592 on the low end and about $602 on the high end. This sideways price action built up a lot of energy. The AMD news acted as the catalyst that finally resolved this range to the upside. We gapped up on October 6th and have been holding these higher levels since. From this hourly perspective, the top of that old range, around $602, is now a key short-term support level to watch. For shorter-term traders, let's drill down even further to the 15-minute chart looking at the past 2 days. Here we can see yesterday's gap up and the strong follow-through during the trading session. However, today, October 7th, we're seeing a slight pullback, which is perfectly normal after such a strong move. This is likely a combination of profit-taking and the market pausing to digest the big gains. The key intraday level to watch right now is yesterday's low around $605.97. A break below this level could signal a deeper retest of the breakout area we identified on the hourly chart. Conversely, if buyers step in to defend this level, it would be a very strong sign of continuation. Returning to the daily chart, let's put it all together and discuss the bullish and bearish scenarios from here. The bullish case is straightforward. The primary trend is up, we've broken out to new highs, and we have a powerful narrative catalyst in the AI sector. Bulls will view any dip towards the $600 to $602 breakout zone as a prime buying opportunity. As long as we hold above this level, the path of least resistance remains higher. Since we are in price discovery, upside targets become psychological round numbers, with $625 and then $650 being logical areas to watch. The bearish case hinges on the idea of this being a bull trap or a failed breakout. Some analysts are already warning about extremely elevated valuations, and the market's ability to ignore risks like the shutdown could be seen as complacency. The first major red flag for bears would be a daily close back below the $600 support level. Such a move would negate the breakout and could trigger a rapid decline to test the September lows near $592. A sustained failure at these highs could lead to a much deeper correction, possibly targeting the lows from August around the $560 area. So to recap, the key price levels are clear. Your immediate support is the recent intraday low around $606. The most critical line in the sand is the $600 to $602 breakout zone. Above it is bullish, below it is a warning. Further support lies at $592, the bottom of the recent consolidation range. To the upside, we are watching psychological levels like $620 and $625 as initial targets. My unbiased take is that there's a roughly 70% probability of a short-term pullback to test that $602 support. Healthy markets need to consolidate gains, and retesting a major breakout level is classic technical behavior. This probability increases if we see consecutive down days on rising volume. There is about a 30% chance that this momentum is so strong that we just continue higher with only minor pauses, especially if more positive macro or AI-related news is released. Keep an eye on any news related to the government shutdown and Fed speak, as those are the wild cards in this tech-driven market. That's our analysis for today. Please remember, this content is for informational purposes only and should not be considered financial advice. Always perform your own due diligence and research before making any trading or investment decisions. Thank you for watching Explain the Charts. If you found this helpful, please like the video, subscribe to the channel, and we will see you in the next one.